the Golden Standard Podcast, brought to you by WeSellSilverAndGold.com. Connect with us online to buy gold and silver at cost, or start your own journey into gold and silver as a business and wealth generator by calling 682-238-1557. Okay, so welcome to your deep dive. This is going to be fun. I am so excited about today's topic because we are diving into some really seriously fascinating signals in the world of gold and silver. And honestly, the stuff we're seeing, it really points towards a potentially incredibly exciting future, I think, for those who are paying attention. We've got some great material today. We've got articles that look at how these big players, hedge funds, are making these strategic moves into gold. We've got expert opinions on how to approach investing in this environment. And then sort of zooming out a bit, we have some really interesting economic news that I think further underscores, the strength and the appeal of both gold and silver. So our mission today, as always, is to connect all these dots for you, and really help you walk away with some really valuable insights that can positively shape your financial future.
It's a very interesting time right now, the convergence of, these institutional investments and these global economic forces and market responses in gold and silver. I think it makes it a really opportune time for, anyone who's interested in potentially making some moves.
I totally agree. So why don't we start with, those big money moves, right? Let's talk about the hedge funds and the central bank. So CBS News, they put out a piece highlighting how gold prices kind of blasted past that $2,700 per ounce mark back in October of 24. And it's really continued to surge, into this year. And while, a lot of individual investors are part of that story, the main driver, the real headline, I think, is this substantial increase in gold allocations from those big institutions, central banks, of course, but especially those very, very smart hedge funds.
And what makes this institutional activity even more interesting is the reasoning behind it. Henry Yoshida, he's over at Rocket Dollar. He argues that a major factor driving hedge funds towards gold over even traditionally safe assets like U.S. Treasuries is the rising concern over tariffs, the persistent trade tensions we're seeing, and this kind of ongoing issue of inflation that, hasn't fully subsided. It makes you wonder, what kind of uncertainty are these sophisticated investors seeing that would make them think, gold is a safer haven than even government bonds?
I think that's a great question. And, to that point, we have Joseph Cavatoni from the World Gold Council, and he kind of doubles down on that idea, saying that uncertainty is at the core of this shift by hedge funds towards gold. And he goes on to emphasize gold's reputation as a safe harbor, right? When the economy is turbulent, when things are rocky, it's almost as if these funds are saying, things are a little bit shaky, so we need something solid to hold on to.
Exactly. And then we have Brendan Aversano from the Owly Market, and he adds another couple of crucial dimensions to this shift towards gold. And he highlights the continued uncertainty surrounding interest rate policies and the fluctuations we're seeing in the U.S. dollar. And these factors, when you combine them, they amplify gold's appeal as a safe haven, right? When the future path of interest rates and the strength of the dollar are a little bit unclear, well, gold looks increasingly good as a stable alternative.
So it seems like this isn't just, a short-term blip on the radar. This is a strategic response by some serious financial players, and they're responding to some pretty big global economic and political trends. So for you, our listener, taking all this in, how should you interpret this institutional buying in your own approach to gold? What are some takeaways you can use?
That's the million-dollar question, right? So Cavatoni, he cautions that the increased presence of these hedge funds, it introduces a note of caution for individual investors. We need to be mindful of potential price volatility. And that's because hedge funds, they often trade based on shorter-term market signals, so their activity can contribute to more, rapid price swings than the more steady, long-term accumulation we might see from, say, central banks.
Right. So while the overall trend might look positive, there could be some bumps in the road. But Henry Yoshida, he gives some really practical advice for individual investors who are looking at all this, thinking, okay, how do I navigate this? His first point is to take a long-term view. He argues that gold really thrives on those long-term fundamental economic factors rather than as a short-term play, right? So why is that long-term view so important when we're considering gold?
Well, gold has, historically served as a store of value, right? Over these extended periods, it's acted as a hedge against inflation and economic instability, things that can really erode the purchasing power of traditional currency. So, over time, it's about preserving wealth, not about chasing quick gains.
That totally makes sense. And he also suggests that, individual investors really should be watching for those buying opportunities. Those temporary dips in price, he mentions like a 3 to 5% pullback. Those could be good entry points, whether you're just starting out or looking to increase your holdings. Don't get swept up in the hype. Just be strategic.
Right. It's a disciplined approach. If you wait for those dips, you can get gold at a better price and improve your returns over time. You just have to be patient and tune out some of that short-term market noise.
And something that both Yoshida and Abersano bring up is gold ETFs, exchange traded funds. And Abersano makes a really interesting point that these, sometimes called paper gold options, they offer a quick and easy way to access the gold market without the complexities and sometimes security issues associated with physical gold ownership. So what are some of the advantages of going the ETF route?
Well, gold ETFs, they offer a lot of liquidity and convenience. They trade on exchanges like stocks, making them super easy to buy and sell. You also don't have to worry about finding a safe place to store them and insuring them like you would with physical gold. So for investors who are looking for market exposure without all those logistical headaches, ETFs could be a great tool.
And for those with a longer-term investment horizon, Yoshida brings up a really interesting point about the tax benefits of purchasing gold through a gold IRA. This could offer some significant advantages through tax deferral or even the elimination of capital gains down the line. That seems like a smart way to kind of build gold into a long-term wealth-building strategy.
Yeah, definitely. When you use tax-advantaged retirement accounts like a gold IRA, you can boost the long-term returns on your gold investments because your money grows without the immediate burden of taxes. It's a strategy that aligns well with gold's role as a long-term store of value.
And finally, a principle that I think applies to any asset class, diversification. Kevin Bryan from the Alloy Market, he advises, to balance your gold holdings with other assets that could hedge against inflation, maybe other commodities. The key takeaway here is don't put all your eggs in one basket, right? Why is that diversification so crucial in today's environment?
Diversification really helps to lower your risk. Different assets perform differently under different economic conditions. So by spreading your investments across a variety of assets, you reduce the chance of being hit too hard if one particular asset goes south. Gold could be a great way to diversify, especially when other assets are being volatile or underperforming because of inflation or maybe a recession.
So let's shift gears a little bit and talk about some potential risks and some key market signals to keep an eye on. Brandon Aversano, he points out this really direct connection between the U.S. Federal Reserve's interest rate policies and gold demand. Typically, when the Fed lowers interest rates, gold looks more attractive, demand goes up. On the other hand, when the Fed hikes rates, gold can become less appealing because now those interest-bearing investments, they start to look a little bit better. So paying close attention to the FOMC's, that's the Federal Open Market Committee statements for any hints about future rate movements, that's a big deal. Can you break down why interest rate decisions have such an impact on gold?
Sure. So gold itself, it doesn't generate any interest or dividends. So when investors are deciding whether to hold gold, they often compare it to assets that do pay interest, like bonds. When interest rates are low, the opportunity cost of holding gold, meaning the potential interest you're missing out on, is lower. So gold becomes more attractive. But when rates go up, that opportunity cost increases, and suddenly those interest-bearing assets, they start looking better compared to gold. The FOMC statements basically give us clues about where they think those rates are headed in the future.
Okay, that definitely clarifies the connection. And Henry Yoshida, he brings up another really interesting point about central bank purchasing activity. So if we start to see these major central banks slowing down or even halting their gold purchases, that could signal to hedge funds that maybe it's time to reduce their own positions, which could put some downward pressure on gold prices. So it's not just about the current buying, it's about watching for any changes in that behavior. Why are central bank actions so influential for other big investors?
Well, central banks, they hold massive reserves, and their actions often reflect their long-term economic outlook. When they're consistently buying gold, it suggests that they believe in its long-term value as a hedge against global uncertainties. So if they change their buying patterns, other large investors might interpret that as a sign that the fundamentals for gold are shifting.
And Yoshida also highlights that the global trade policy landscape plays a really big role here. If things start to feel more stable and there's more confidence in international trade, that could lead to decreased demand for gold as a safe haven, potentially pushing prices down. It's this really complex interplay of economic and geopolitical factors.
Right. Gold's popularity as a safe haven really thrives during times of uncertainty and risk in the global economy. When things feel more stable and secure, the perceived need for a safe store of value diminishes, and that can impact demand for gold.
Okay, so let's widen our lens a bit and take a look at the overall economic picture. This What Else is in the News article that you sent over, it paints a really interesting backdrop for all this activity we're seeing in gold and silver. So even though inflation has cooled down to about 3% in January, a whopping 63% of Americans still see it as a very big problem. That sentiment, I think, has a lot of power.
I think so, too. It shows that even though the official numbers are improving, people are still feeling the pinch. They're still looking for ways to protect their purchasing power. And historically, gold has been seen as a hedge against the erosion of wealth that inflation causes.
And adding to that economic unease, JP Morgan has actually raised the probability of a U.S. recession in 2025 to 40%. They even suggest it could go above 50% if those proposed tariffs are implemented. And we're also seeing some major investment banks like Goldman Sachs and Morgan Stanley lowering their growth forecasts. There seems to be a growing sense that things could get a little bit tougher economically. And what's really striking, 95% of North American economists believe that the previous administration's trade policies have actually increased the risk of a recession. So how does this heightened recession risk play into the appeal of gold and silver?
Well, during recessions, traditional assets like stocks tend to take a big hit. Gold and, to some extent, silver, they're often seen as safe havens that can hold their value or even go up in those times because investors are looking for less risky places to park their money. So the higher the risk of a recession, the stronger the argument for holding precious metals as a way to protect your capital.
And it's not just gold that's making moves. Silver has seen a really impressive rally too, hitting a 5-month high above $34 per ounce. That same article points to those trade tensions, the tariff policies, and expectations that the Fed might cut rates because of that softer inflation data as major factors pushing silver higher. Now, silver often seems to move in tandem with gold, but are there other unique things driving its price?
Yeah, for sure. Silver shares some similarities with gold as a precious metal, but it also has a lot of industrial uses. It's used in electronics, solar panels, all sorts of things. So its price is influenced both by investment demand, like gold, and by industrial demand, which is tied to economic growth and technological advancements. And when people expect rate cuts, it can also boost silver's appeal because it makes it a more attractive investment compared to those interest-bearing assets.
And then there's gold, which has been making headlines by breaking through that $3,000 mark and even reaching as high as $3,047 per ounce. The article highlights the escalating tensions in the Middle East and those growing U.S. economic concerns as major factors behind this surge. And there's another really interesting piece of data. We've seen 5 straight days of inflows into gold-backed ETFs. Their holdings are up 5% this year, which comes after 4 years of decline. That seems like a pretty strong vote of confidence in gold's ability to protect wealth.
Absolutely. That shift in ETF flows is really significant. After a period where gold might have been on the back burner for some investors, this surge in inflows suggests that they're putting it back in the spotlight as a safe haven and a reliable store of value in these uncertain times.
And the price projections from those big financial institutions are really something. ANZ Bank is predicting $3,200 within 6 months. UBS has also set its target at $3,200. Analysts at Macquarie are even talking about a potential record high of $3,500. And Jeffrey Gunlock thinks gold could reach $4,000. They're pointing to that surging safe haven demand, growing fears of a global trade war, and concerns about the U.S. deficit. These are some pretty big calls from some well-respected experts.
I think those price targets really highlight the potential for gold to keep climbing if the current economic and geopolitical worries continue or get worse. When you combine safe haven buying with trade war fears and concerns about government finances, it creates a really powerful upward force for gold.
So let's bring it all together for you. We've seen those big institutional players, hedge funds and central banks increasing their gold allocations. They're driven by a combination of uncertainty, inflation fears, and trade tensions. And all this is happening against a backdrop of broader economic vulnerabilities, like those rising recession rates and those persistent worries about inflation. The markets have responded with some significant rallies in both gold and silver prices. It seems that the very same reasons why those large institutional investments are finding gold attractive, that uncertainty, those inflation concerns, the potential for an economic slowdown, and those geopolitical risks are also really relevant for you, the individual investor who's trying to protect and maybe even grow their wealth in this environment.
Exactly. The core reasons why these big institutions are turning to gold as a strategic asset are often the same reasons why individual investors should be thinking about how gold fits into their own portfolio. It's a really valuable hedge against a lot of the economic and geopolitical risks that we're seeing right now.
And I think that point from Kevin Bryan about knowing your why for investing in gold is really important. Whether you're looking for long-term protection against inflation or a more tactical way of handle potential market swings, the current environment has both opportunities and potential downsides. So having a clear understanding of your investment goals is crucial.
Definitely. Your individual financial goals, how much risk you're comfortable with, and your time horizon, those should always be your guiding principles when you're making investment decisions. Gold can play different roles in a portfolio depending on your specific circumstances.
And going back to Henry Yoshida's advice, he really emphasizes that you need to assess your own unique financial situation. It might even be a good idea to talk to a qualified financial advisor to figure out the right amount of gold to hold in your portfolio, even if it's a small percentage, like 1% to 5%. It's all about finding the right balance for you.
Absolutely. A personalized approach is essential. What works for a massive institutional investor might not be the best strategy for an individual. Getting some professional guidance can help you create a gold investment strategy that aligns with your specific needs and goals.
The Golden Standard Podcast, brought to you by WeSellSilverAndGold.com. Connect with us online to buy gold and silver at cost, or start your own journey into gold and silver as a business and wealth generator by calling 682-238-1557. So as you can see, the combination of that hedge fund activity, the consistent buying from central banks, and this complex global economic situation is creating a really dynamic and potentially very rewarding landscape for both gold and silver. The insights we discussed today should give you a solid understanding of what's driving these markets and where they might be headed. And hopefully this deep dive has not only shown you what's happening, but more importantly, why it matters to you and your financial well-being. Now, here's something to think about. With all these big financial players making significant moves into gold and silver, what kind of broader, maybe even game-changing shifts could we see in the global financial system in the coming months and years? It's a question worth pondering.